one of the things they should understand is some natural realities about growth. For example, someone growing at 10% a year, they'd say that's very modest. 10% is nothing. In 5 years, you've grown 60%. In 7 years, you've doubled the size of your business.
Yeah.
So 10% is actually considerable growth. But there's 2 or 3 good jobs, and I have the opportunity. My market's growing. I'm growing at 20%. You double your size in 4 years. Now there's even more work, and I grow at 30%. If I continue to grow at 30%, I am actually going to double my size in 3 years, because it compounds itself. It's like compound interest. And you can't really double your size overnight. And anyone that thinks they can is taking a real risk. And somebody in this audience is going to say, I've done it. Yeah, I hope you haven't done it years in a row. You just did it 1 year, because there's growing pains. So we have this natural growth pattern that's a problem, and we can't continuously grow. If we have a burst of speed, the market's good, we can get the people, we can do the work. We're still not sure we can price it, because we're pricing it now really fast. And they say, well, I got 3 new estimators. And my answer is, yeah, you got 3 new estimators, untested. The only way you know how good they are is when you get the work, finish it, and it comes in at the price they've set. So new people are a problem. There's nothing wrong with them. You just have your own system, network, and culture that's working on your behalf. So you're straining. So my advice is that we need to grow at some kind of reasonable pace. And even at a lower pace, if we're straining our organization to grow for, say, 3 years in a row, we've grown. That's a struggle. At some point, you need to halfway level off. Don't shrink, maybe not go completely flat, but stop growing too fast, to take a breath, to get organized.
I think you've spoken a lot about this, Tom. I forget what you call it specifically, but essentially it's like stepped growth.
Yes.
Yeah. So that way, and like you're saying, is you grow a bit and you stabilize. You make sure everything's in place. You give yourself some breathing room to stabilize, and you go again. And, that couldn't be more true, because I can't tell you the amount of times when we start working with contractors and they might be turning, $2, $3, $4, $5 million per year, but they've grown from that since 2017. And it's just exceptional growth. From the outside, most people would look at that and go, wow, they must be doing really, really well. But you pop the hood, you look underneath and look at their finances, it's not in good shape, because it's just, the amount of cash that business has needed to resource and fund its growth in working capital and purchasing new assets, investing in equipment, investing in new team members. That just drains the cash. It doesn't matter if you've got 5, 10, 15% profitability on your projects. That rate of growth requires so much cash.
I've actually seen and had to clean up after contractors that cash flowed themselves out of business. And by that, I mean, they grew so rapidly, and particularly taking larger and larger jobs. Seems to me when somebody owes me $500,000, it takes a while to collect it. When they owe me $2 million, it takes longer. And what happens is, I don't know if you have standard retainage in Australia, but typically we have retainage built into our contracts.
Yep.
So we're not paid 100% of what we bill. Yeah. And as that stretches out, we spend the money from day 1 in a month to day 30, and we haven't even earned the right to bill till day 30. Now we bill, and they don't pay us. So from the first dollar we've put in the first week of the month, we're waiting 30, 60, in some cases longer, less retainage, and we're simply not collecting as much money as we're spending, because in growth, we're spending faster than we're being paid. I've actually liquidated companies that every job was profitable, but they were insolvent in that they could not pay their bills, and their banks eventually called their loan, and they were out of business, and they were profitable.